Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, or you want to be a multifamily investor, or you are a veteran of the multifamily industry, good news, you're in the right spot. Because every week on the Gray Report, we're breaking down all of the latest critical research reports, articles, data points, and providing some original opinions and commentary on the multifamily industry, real estate, and the economy at large. We've got some great sources and articles to go over today. Of course, Jerome Powell made a major announcement today at the end of the Federal Open Market Committee's meeting, the press conference announcing a increase to the Fed funds rate of 75 basis points, basically as expected. But other reports from Redfin, Zillow, Integra Realty Resources, Globe Street, Fortune, we're going to be talking about rents, home prices, and where this market may or may not be going. Let's get into it. Welcome back to the Gray Report. Once again, joined by Director of Communications and Marketing here at Gray Capital, Matt Bosnagel.
Hello.
Matt, great report you put together today.
Thank you.
I am looking forward to the newsletter that's going to be going out on Thursday.
Oh, yeah.
Make sure if you're not signed up for that, you can pop on over to graycapitalllc.com/newsletter. Not only do we include these reports, Matt, but like 20 other reports. Mm-hmm. And one thing that I found interesting, we started doing it first for ourselves and then something we wanted to share with investors. But the largest consumers of the Gray Report newsletter, I know you know this, but it is industry insiders, syndicators, brokers, and lenders.
Yeah.
So people who are actually in the industry are using the Gray Report to stay on top of the market. So if you are an individual investor, an industry insider, again, just trying to learn more about the market, this is the number one resource that professionals are going to. So I'm very proud of.
Yeah,
I know you are too.
Same
Matt.
here. It's nice. It's nice to have built it, and it's really
Absolutely nice.
It definitely has improved for sure.
Absolutely. And let us know how we can improve. We're always looking to get better. Leave a comment below. Make sure you're subscribed to the channel and give us a like. Helps the YouTube algorithm, and who doesn't like helping out an algorithm here and there. Matt, how's your week going, man?
It's going pretty good. This one's going by pretty quick, it seems like.
Yeah, really quick. A lot of things are moving quick.
A lot of stuff to chew on this week, especially. I was kind of waiting a little bit on the Federal Reserve rate, but it doesn't seem. It seems like more of the same.
Me, and everybody else, waiting for something that we had a pretty good idea of exactly how it was going to turn out. Although some people were thinking maybe we'd get a 100 basis point increase, went for the 75, maybe another 75 in November.
Yeah.
They want to take down inflation. I wonder. I wish we could be. And they're going to release the minutes of the FOMC meetings. But I'm just curious. Related to our conversation last week about the role of housing as a percentage of CPI. It makes up about a third of CPI, and we know that CPI data is lagging. It's really not very accurate compared to all the high frequency, real time, and better sourced rent tracking information, because we've seen some softness in the rental market for sure. I mean, rent growth we're past the peak of growth. We're slowing down. There's seasonal elements to it, but we're certainly seeing a little bit of a slowdown without a doubt. But did that trickle into that conversation at the OFMC? I don't know. It doesn't seem like it.
I mean, depending on what they're using, if they're going to use CPI numbers, then we probably won't get to level month over month inflation until later this year.
Yeah.
But if maybe there's someone that reads the Gray Report, and they know
that's a good chance
that things are coming close to zero. In terms of month over month, now year over year we're still pretty high for apartment rents, but they're dealing with lagging indicators, and the Fed funds rate, when it gets increased, it happens now. When we read the CPI, we're reading about July to August, and so that's a couple months away from now. It's the 21st, and they're measuring things that happened in July.
Yeah.
So there could be some significant changes that happen that we don't know about that have already happened in August.
Yeah.
It's already September.
Yeah. No, I know it's kind of garbage in, garbage out, and they're kind of using a little bit of garbage in. At least looking at housing makes you wonder about some of the other inputs and how accurate or not accurate. And just what's influencing those.
Now, as we'll see, though, some of the moves, especially in this Zillow report, they have a nice graph of month-over-month price changes in home prices, and there's some dramatic moves. And that actually, more than any like thumbnail of apocalypse and flames in the background, that's kind of concerning. And it may be signs of something, at least, if not like lasting, at least something that's like substantial and worth noting.
Yeah. I was at a meeting, man. I was telling you a little bit about this. Or it was a dinner last night. That one of the large national brokers put on pretty intimate dinner. It was only owners of quite large apartment communities, and the biggest it was interesting because it's a little bit of an echo chamber. All multifamily owners, developers, everyone's raising equity for multifamily, but there's still this where the consensus. There's consensus on two things. One, it seems like we're in an inflection point related to interest rates and cap rates. Cap rates are just still too low where interest rates are, and something's got to give. Now, the national director of this brokerage firm, he's saying, hey, if you want to get in, you got to use negative leverage. No one's buying real estate for those year one returns. You're going to grow out of it, because we started comparing to treasury yields and corporate bond yields being competitive for kind of fixed income products relative to yields that multifamily apartments are offer, the cash flow that multifamily apartments throw off. And that didn't really sit well with everybody. Some people were fine with it, but there was consensus that like just something's got to give, and it seems like it's right around now. But then the question that we talked about last week and a lot, and I had handful of conversations with investors this week who told me this is, what is the alternative? What else do you go into? What else isn't seeing a slowdown right now? I mean, this is a global slowdown, and the things that we know are that the United States is most likely going to weather this global economic slowdown better than anyone else, like absolutely going to be the best. Foreign investment has already been pouring into the United States, whether that's in treasury bonds, keeping the 10-year treasury relatively low compared to the 2-year treasury, or stable, real estate and other real assets. And that's a piece of consensus is that where else do you go? It's multifamily. The fundamentals are still incredibly strong, even with these headwinds, and it still seems like the best place to be, especially if, and I would almost say only if, but especially if you have a relatively long-term investment horizon. If you can hold on for more than 3 years, you're probably going to be in a good spot. If you need to sell in 2 or 3 years, I don't know. I can't say that you're going to have a successful investment. Probably will, but I don't know. 5 to 10 years, I know as long as you're buying relatively right in a relatively good market, you're going to see some profits and some success, assuming you halfway know how to operate those deals.
I'm going to be interested to see how all of the all this talk about softening markets, how that will affect supply, whether it's length of completion, whether it's plans that maybe get abandoned at some point, maybe earlier stages. But that's the other factor here is the reduced profitability. Is that going to mean that all these projects are that something happens to supply, that some of our completions maybe they won't happen? That's my big guess. But when you're talking about inflation rate, or I'm sorry, interest rates in general, I looked back. I did a filtered Google search, and I tried to find all the people that were calling for 1% rate hike, and I really kind of couldn't. It was the majority of the people were saying 0.75%, and they were calling it hawkish. And I think that it becomes you get fixated. Well, it's been 0.75 last month, or last time. Maybe it is going to be 75 basis points this time, and you kind of get focused on that. But man, it's this consistent pressure that we're getting. It's not insignificant, I think. Monetary tightening continues as well. So like the Federal Reserve is reducing liquidity, and they're really tightening things when it comes to interest rates. It's a double whammy, and I don't think that we're going to see the end of it. I think we could see reduced inflation because of this. I don't think that's out of the cards just because of the confluence of all these things.
I mean, I think they'll get there eventually. It's just what's the collateral damage, and as Jerome Powell said, is there's going to be pain. Everyone's going to see some pain. We're all going to go through it, some more than others. But can you stomach that pain, and then how do you position yourselves to experience the least amount of pain possible? So everyone's going to experience some. How do you set yourself up to experience the least?
And like overall, that's I was thinking, we're at an elevated interest rates right now, at least for the past few years.
Well, especially, yeah, definitely higher rates. And then especially, and I think this has been talked about more and more, is not just what the nominal interest rate is, but what is the real yield, the inflation adjusted yield of these treasuries. And they are now, the real yields on these treasury bonds are now at very high levels, within the last 2 decades or so. And because the concept, the interest rate can be whatever it is, but it's relative to growth. And in terms of how restrictive it actually is. For example, we could have interest rates of 5%, but if inflation's at 15, well, that's relative to interest rates being at 5, but inflation is at 5.
Yeah.
If inflation is anywhere near to, what's that real yield? If it's 15%, CPI growth and inflation, but your bonds are only 5, you got a negative 10% real yield.
Yeah.
So that real yield is determining how restrictive we're being on the economy. And where we can get really tight really quick is if we do see inflation slow down and CPI really kind of dropping precipitously. That's when that real yield is going to start rising very quick and becoming incredibly restrictive. And we might see it this winter.
See that, and I just keep thinking back to absolute. This, we're not talking about like growth rates where we're like year over year or month over month. Where there's always a steady kind of assumed growth. It's not the same way when we don't assume interest rate hike. That's like a constant that drives the other growth that we're seeing in the economy, kind of, or drives the shrinkage.
Yeah.
But that being said, like for them to keep things the same, that's an action, and I think it's worth considering that I read articles that said 0.75 was hawkish. I think it is hawkish, and if they continue to do it, I think it will be. And even if they, maybe next month is 0.5%, or I'm sorry, is it 50 basis points instead of 0.7%? That's still rising, and it shouldn't be cause for a huge celebration. But at least I'm hoping that they start to make interest rates a little cheaper. I think it's time. I'd like to see it.
I think the problem is that they're going to need to see unemployment go up before we're probably going to be able to get to that point. And that's where that pain comes into play. And we've already seen a lot of layoffs, especially in the tech sector. The tech industry. A lot of these technology companies, their values have been slashed by 50, 75%. And again, seeing a lot of layoffs. They're already seeing the pain. In the multifamily industry, we're not really feeling it yet. We're just kind of assuming that there's going to be some around the corner and kind of batten down the hatches. Yeah.
Core CPI was 0.6% last month, according to CPI. So that's still, I think that's 7.2% if you spread it out over a year. So there definitely is ways to go.
And again, the stock market keeps getting beat up. This is interesting. I had a conversation with a large investor yesterday, and in an initial call the week before, they had said, love investing with you all, but I don't know if we'll be able to do. And he represents like a investment group, family office, and he's like, I don't know. We'd like to, but with the stock market where it is, I just don't know if we're going to have the liquidity and the dry powder to, make a large allocation. Because these guys usually invest, $1 million into each one of our projects. But totally understand, totally, reasonable. Just let us know either way. And then I get a call yesterday saying, we're limited on dry powder available, but our thought is with a preferred return, with reasonable assumptions, where else are we going to go with this capital right now? There's no other better place that we see, no alternatives. And we're looking at a lot of alternatives, and this still seems like the best place to go. So I think that's where the conclusion that a lot of folks are making, because the long-term fundamentals still are incredibly strong. It's just, it's going to be an interesting year to get through. To say the least. Yeah, that's a really good point. And just about the kind of interconnectedness of the economy, and that's something that came through in this is both the connection between rentals and home prices, and the connection between the housing market and the economy is really runs through all of the reports that came by this week. I heard a comment today actually that on the same note of fear and greed, and there's a lot of fear in the market, but the greed's going to overtake the fear in a sense that like, I still want to make money. I don't, and I'm losing money by sitting in cash letting the value being eroded away, and that desire to like make some decision to get moving. You never want to make a decision prematurely to something that doesn't make sense, but people still want to keep making decisions and making investments. So. All right, Redfin. We got a report from Redfin, Matt. Is it a good one?
I think it's interesting. I definitely read through this, and it wasn't. They didn't have like a huge amount of conclusions, other than they say that rates, and this is a quote. They say rent growth will likely slow further as the Federal Reserve continues to raise interest rates, which they just did. Higher interest rates impact the rental market because they put a damper on spending power in the economy as a whole, which you kind of just said, including renters' budgets. And he said. Growth in rents is also likely to be slowed by a boost in rental supply. There are nearly a million rental units under construction that will hit the market in the coming months and years. I think that last word, years, is a lot more appropriate maybe to describe.
Coming months and years.
Yeah. So, like I may have alluded to, the first point I think is valid. When you think about things that affect the economy broadly, it's going to have an effect on the rental market. The second point I think is a little more up in the air. Like I said before, how maybe construction times are going to get extended. Maybe there's going to be a voluntary choice instead of one maybe limited by materials prices or labor absences. Then maybe we're going to see people just saying this is not profitable anymore. We can't hit our numbers. Now that might happen maybe to earlier points, but I think the point still stands. There is, and the thinking about new supply coming on the market is also very market by market based. And my thought is, and this is only because a couple of reports have said this, you're going to see the softening in prices in high flying markets of 2021 first.
Yeah.
And I don't think that it's going to happen in maybe the more steady Eddie markets like in the Midwest.
Well, speaking of that, Matt, this next little paragraph is rents rose more than 20% in Cincinnati, Pittsburgh, Indianapolis, and Nashville. So, in Cincy, you want to break into this?
Yeah, I did. I looked actually. I have some comparison because we had those three reports that came by last week.
Yeah,
they have the average year over year at 11%, down from a peak of 19% for the nation last March, this past March. So the number for Indianapolis is number 3, which is at 21% for Redfin. CoStar had it at 10.1%. And then in Cincinnati, Redfin is 26% to CoStar's 9%. And Redfin has Pittsburgh as the third one. Doesn't really have any numbers actually for CoStar. Markets with rent declines they also covered, which Milwaukee at negative 15%. I didn't find the numbers for CoStar in that, but Minneapolis, CoStar has positive numbers, positive 2.8 to Redfin's negative 7%. And then Baltimore, CoStar has a positive 4.8 to Redfin's negative 1%. So what I noticed in this market information is a lot more volatility, a lot more higher extremes. They come to the same month-by-month average and within the same ballpark of the year-over-year averages as other reports, but there are some wild swings when you come to market by market.
Can you give us any insight on the differences in methodology between the
I think it's purely a result of the pool of information that they have at Redfin, and it may be their burgeoning rental data system or whatever. Their sample, I think, is different, maybe a little bit smaller. That's what my guess would be.
I was going to say, because I know CoStar is using apartments.com data and some other sources. I'm wondering if could Redfin be using more single-family home data because they do more single-family rentals? That
could be it.
Because I'm looking at this average rent in Indianapolis of $1,531. Mm-hmm. That's a little bit higher than what I've seen.
Yeah.
I've seen it closer to kind of $1,200, $1,300. So that seems a little high. Now, if you're factoring in single-family homes, that would make more sense.
See, this is what we're doing here. We're comparing reports and we're figuring out, and this is exactly what I was thinking about when I was writing this. Is why is this so weird? And it's because, and in the end, how do you judge credibility? It's not like there's a seal of approval that you get. So you got to go to the methodology. You have to think about the company, the reputation of the company, and
what business they're in.
Yeah. And so, when I'm glad you scrolled to that. The methodology they said they analyze rent prices across. They use data from more than 20,000 apartment buildings across the country. So this is asking rents, which CoStar also measured asking rents, so it's the same measurement, but different data.
Just different data.
Yeah. So we spoke last week about how RealPage reported August 2022 rent growth even with August 2021. So rent growth on top of rent growth. And in this compounding push upwards, Redfin actually records higher year-over-year rent growth at like 11% than we had in August 2021. So we're actually at a little bit higher, and you'll see this through a lot of different sources that we've that we covered today and in last week. We have like almost a full year of elevated rent growth, and we're going to have even more, maybe even 2 years of rent growth above at least 5%, according to some of these trends that I'm seeing.
I think that if you believe that inflation is just going to kind of stick around for a while, I think that you would have to also believe that there's going to be some elevated rent growth levels for a while. Not that I could see some snap declines and then some snap growth back. I mean, I think we're still in this, this period of just oscillating back and forth, and like the shock of the money supply that was created during the pandemic and all the secondary tertiary effects that were caused by that. And I think big peaks up and troughs and peaks and troughs, and they kind of half. And
I've been watching a lot more than any other time in the past couple of years. Been watching the month over month to try and see where things are going, and it looks like a trend's starting to form. But I'd give it a couple more months before I could really label anything. We're definitely in this moment of transition.
I wonder if we could do some technical analysis on rent growth. Use some like Fibonacci retracements or some Fibonacci like spirals.
I need to brush up on my statistics and data
maybe
analysis.
We can use astrology.
I think that might be a little bit. I'd be more comfortable with that.
Yeah. All right, report from Zillow, August 2022 market report. Let's just kind of start comparing these and see what Zillow has to say. We're all familiar with Zillow. And you might be listing your house, apartment with them, looking for something to buy, looking for something to rent by chance. What do we got going here? Potential home buyers and sellers continue to hesitate. Prices continue to soften. August 22 market report.
Yeah. So we are seeing softening. Now, I haven't looked at the Case Shiller. I'm not sure if it is out yet. The last one I saw from Case Shiller, we were a little bit even with home prices. They're still going up, but I think this is not the only place that has signaled softening home prices. And at the very least, I've seen everywhere is how the sales of homes are going down. Now, on the other hand, like sellers are holding off too. That was one of the results of this report and some other articles that we've seen, is that a lot of people are choosing not to sell their homes. And it's almost this, it's like, if you don't want to sell, what's going to force you to sell your homes? And are people going to be forced to, are they just going to hang on for as long as they want?
I think they're just going to hang on. I mean, if you locked in a 2-3% interest rate, and you see interest rates at 6.5 right now, I mean, why would you pay to have the same payment? You're going to have half the house. Or if you want the same house, you're gonna have twice the payment. And then tell me someone who that makes sense.
If that is happening, that same logic has to be happening for people who are currently renting and thinking about buying a home. I know we have said that it's not going to affect apartment rents, and I think largely it won't.
Well, Jay Parsons, I think comment was that it's more on the margins than anything, and I can't. To me, I can't imagine that's just on the margins, because that's a big segment of the not only renting population but the home buying population as well. It's those millennials in their mid 30s are thinking to make that choice, and that's the peak median age of the population right now in the United States. And so if they're all like putting that decision off, that's a lot more people that are renting. Who are going to be renting relatively high-end apartments too. Now,
I think that this may be this just kind of pause where everyone's holding off right now, and then there's going to be some kind of price realization, and then everyone gets in while they can.
Well, this is somewhat related to all of this. Is I saw a report recently, and I'll have to find it through on the report. But traffic, I think Jay Parsons threw this out there also. Is traffic apartment traffic is down, not just like below 21 levels, but it's down below 2018 levels and 2019 levels. And the idea being is retention is up. People who are in an apartment, they don't want to move apartments because they know that the rent increase is going to be so much higher than if they just renewed to where they're at their existing apartment community right now. Mm-hmm. So just more people are staying put, less people are leaving.
Yeah.
And for rent growth to continue to accelerate at a higher rate, or rates like we saw, which I don't think that they will, and they probably shouldn't. You need that people moving around, that velocity of signing new leases at higher market rents, but instead a higher percentage of renters are renewing at a relatively lower increase. So I think that's got to have some effect. It's not going to affect the market rent. Well, it's not going to affect the market rent growth as much, although that'll certainly put some downward pressure on it. But it's going to affect the effective income of the property.
Yeah, I think it is interesting, and I did look back at some of the renter retention trends that they highlighted, I think, earlier this month, and how people are actually, when some of the times during that we saw a lot of it really strong, the beginning of the rent growth, retention actually started to like increase as well. So there's a weird correlation.
Yeah.
I think at our current moment, it's definitely a case where people can't flip out and go into a new one.
Yeah.
And without
taking a big hit financially. I mean, it's like not even a choice. It's like I can't do that.
Yeah.
I got to stay put. So just in context again, monthly mortgage payments, I mean, they're up from around $1,000 or below now up between over $1,600. That's pretty pretty impressive.
You can see that monthly mortgages have more or less like quote unquote leveled off, but it's still at a very elevated level. They're up 58.8% year over year. That's not sustainable. There has to be kind of something that happens there, I think. And another thing of note, like I said, is that more people are selling, and there's all these signs that it's a softening market. Year over year, home prices have gone down slightly for 2 months in a row. The month over month numbers show this significant reduction in home values and some real drama. That's what I was kind of alluding to before. That is more persuasive to me than kind of general trends and kind of feelings about the market and signs that you're projecting. It's this sharp of a decrease as it was an increase in home prices in the run up during the pandemic. We're seeing that right now, and that's what I'm a little bit worried about. If this has staying power, again, I will caveat it. It does seem so much determined by this external force of the Federal Reserve. And once that pain's like, maybe if we shout hard enough, we clap hard enough, Jay Powell will hear us.
Maybe one day. I think one day. But interesting, just again, back to focus on some of these price changes. The Midwest is staying relatively kind of staying pat. Again, it's a much more less. You don't get the booms, you don't get the busts. It's just linear, steady eddy, just continued growth. So according here to Zillow, more affordable markets in the Midwest are generally retaining their heat, while competition is cooling most rapidly in the Western markets, especially those with the highest home prices and the ones that saw the most home price appreciation over the pandemic. Home values rose from July to August in 12 of the 50 largest U.S. markets, led by Birmingham, Indianapolis, Cincinnati, and Louisville. Those four all have a typical home value under $300,000. Miami, the fifth spot, breaks the trend here, but also features the highest rent growth over the last 3 years by far, which could be stoking demand for purchases. So again, I mean, not just saying to say it, but three markets that we're targeting, Indy, Cincy, and Louisville, for a lot of these reasons, it's just they're much more steady markets compared to some of the higher flying markets. All right,
just looking at this graph that they have on Zillow of the month over month, I just it's easier just to see it, even though if for listeners of our podcast, they may just watch it. But this is the for sale inventory, and it shows how much inventory has fallen. And it's fallen fairly precipitously over the past few months, down to maybe 1%, 1% growth in inventory. Now it was really low in December 2021, about what is it?
Okay. And so my only comment is just, this is like some obvious like season. And I feel like I'm a broken record talking about seasonality, and I don't just want to say like, hey, this is just stuff that happens every year, because the things are different. But part of this, and again, a lot of these more high frequency stories of like, hey, we're seeing major declines. It's like, well, what if we see that's because everyone went to school and no one's shopping for houses right now. Yeah.
And that is a good point, but it also makes me a little bit more worried sometimes. We're at this point right now where where we're level with rent growth, level maybe a little bit, we're declining in home prices. How much more how much more do we have to fall?
Yeah.
When do the seasonal trends kind of peak in the wintertime, and when do they start to soften when it comes into the spring?
Well, here it's pretty, I mean, December,
mm-hmm.
December, and to snap back down in February, December.
Yeah.
I mean, that makes plenty of sense. Who's buying a house? Who wants to buy a house like during Christmas week or during Hanukkah, or, no one wants to buy a house in December or before New Year's Eve. Everyone's, your banker, your real estate agent, your attorney, whoever. It's the same thing, sort of. I mean, we buy apartments in December because we have to, but we went under contract on them in September and October, and then we close hopefully not at the end of December, early December.
Yeah.
But it makes sense. We're not looking necessarily to buy new stuff. There's a seasonality to this. Most industries, businesses have seasons. There's renting seasons.
That's what I was going to ask
home
you.
buying seasons.
I'm very much more familiar with rental seasons. I didn't know if home buying seasons were as effective, but it definitely seems like it. Like you're down negative 10% every December. So
I'm just curious. So, in August 22, inventory is down negative 7.2. In August, I mean, inventory was down even more, 18.5 in 2021. And in 2020, it was down by negative 23. So I don't know what my conclusion is. Well, in 2019, it was only down by 2.3. This is when it was sort of more normal times. Yeah. So, I mean, still much lower inventories versus historical averages. I agree, though. I mean, and again, this comes back to the conversation of, are we at an inflection point? That the conversation where I was having at dinner last night, we're at an inflection point of just like these interest rates are too high relative to the value of the assets.
Yeah.
And we're at a breaking point, but you got to have a lot of sellers to really move the price. And to your point, Matt, which of these homeowners are going to be sellers right now?
Mm-hmm. Yeah. So I can't help but think that this is a temporary thing, and that hopefully there will become a point in the economy where things are going to where these trends are going to start to reverse themselves. And I can't imagine a situation where we're in January and Jay Powell is still raising rates by 0.75% every month. I just don't think that will happen, but.
I don't think it'll become political. It's going to be politics. It's not going to be economics. It's going to be, when is it politically infeasible to be able to do? And if you don't think the Biden administration, thinking about the
no, they're independent. They're completely independent.
They don't talk. There's no indication, no back channeling. But I mean, between the midterms coming up, and it may be too late for the midterms. It's probably all baked in.
Yeah.
But if they don't turn this economy around, the Democrats are going to have a hard time in 2024, I mean, whether Joe Biden's running or not.
One thing that that was kind of interesting, and we all talked about inflation all through, ever since May of 2020, we've been talking about inflation or projecting inflation or the impact of it. It really didn't start to enter the conversation for real until the beginning of this year, when it became this huge worry. It's we can take so much. We can take this thing, and even the official economists were
it's just a flash.
Yeah, let's just wait. We're going to use these different moving goalposts to measure it now. But I don't know if you remember that.
Yeah,
we're doing some rolling average. But anyways, there was a point where things started to hurt, and I think that if we continue, we just can't keep doing this without things starting to hurt.
I agree. It's a weird time of where some things are just totally seeming to be messed up, but then some things look like they're great. Again, unemployment is low. Wages are growing. We are, this isn't I guess it depends on your perception of this, but even tax revenue is peaking right now.
Dollar's pretty strong.
Dollar's very strong. But the stock market is in the complete tank, and cap rates are low, and interest rates are up, and there are parts of tech industry has going through a bloodbath right now. Inflation is high, but gold isn't high. It's just a weird time. And again, just talking to people who are more years than I and more experience and have been through a lot more cycles.
Yeah,
this is unlike anything ever anyone has ever experienced. So there's no playbook. There's no good analog. There's no going back and saying this is what we do next.
I know. I'm like, what are we going to think about this? I've got thoughts about 2021, but I still don't. I'm not sure like what the causes behind those specific circumstances were. But then like in 5 years, are we going to say, yeah, this is when we started paying for the pandemic, or are we going to is it going to be some other thing that we didn't even notice? Like the housing crisis was in the 2000s.
Yeah.
Is there going to be some sector where we can say it's a concrete thing, no matter if it really was like the rules around housing wasn't specific housing? But like, yeah, I just want to know if there's going to be a linchpin or a scapegoat. It's hard to find one.
Yeah, and I think that there could be. I don't think it's going to be in housing though.
Yeah.
Just because there's so much momentum, going in a certain direction. I think that the Federal Reserve is throwing everything at it to kind of try to slow it down.
Mm-hmm.
But I think that there could be some other part of the economy. But I do think that it shows the strength of the U.S. economy. And again, it's the U.S. economy. It's not the European economy or the Chinese economy or anywhere else in the world. It's the U.S. We're in a very unique spot for a variety of unique reasons between we produce our own energy, so we're somewhat insulated from all the stuff going on in Europe with Russia and pipelines and rising energy costs. We are much more innovative. Obviously, we believe a little bit more in free markets than others. We're more adaptable, nimble, and move quicker. Mm-hmm. And not to say that there's not like other amazing countries out there, but just like looking at the makeup of the economy, and there's drawbacks to all that in the United States. But speaking in pure dollars and cents economic terms, we're set up better than anybody. Mm-hmm. Not to mention, the U.S. petrodollar. We've got the aircraft carriers, we got the guns, we got the nukes. We can kind of set world policy pretty quickly. And come back to, international investors know that. So the investment in the United States is going to, again, breed a lot.
There was a recent report on global capital flows. Yeah. And for the first half of the year, it was a little bit of a lagging indicator, but people are still excited about investing in American commercial real estate. Yeah. So that has not happened yet where
you're going to invest in, in UK flats or retail or office. UK, you want to invest in a UK office building right now? Your gas, your heating, oil is going to be, like whatever multiple that it usually is. Yeah. You have to cover that. I mean, no thanks. I mean,
it is. It's crazy how it does seem to point to multifamily, like you said before, as this not necessarily sanctuary asset, but something that's definitely robust and suited for our current moment.
It's like what's going to see the least what's going to see the least amount of pain in the short term, and then prospects for strength over the long term.
Yeah.
And I think that there's a lot of just clouds and confusion over a lot, but there's a little bit more certainty in multifamily. That's for sure. All right, in this Integra Realty Resources IRR multifamily, well, this is a report on all commercial real estate, Matt. And IRR, they do some consulting and advising and real estate valuations. You can go check them out on the internet. IRR reports multifamily assets traded at record highs as most U.S. residential markets rocketed through Q1. Recent activity suggests a dramatic cooling in single-family home and volume and values, and this will surely affect forward rental rate forecasts negatively. IRR reports 80% of U.S. multifamily markets are in the expansion market cycle phase, up from 76% in Q4 of 2021. Rents increased across all regions. B-class property rents in the South region increased the most, up 10%. But nationally, vacancy rates have dropped for both A and B class properties, down 5 bips and 48 bips respectively. However, the only regions that saw increases in vacancies were A class properties in the East Coast regions and Central regions, up 38 bips and 28 bips respectively. Integra's viewpoint research indicates continued cap rate contraction. Urban Class A cap rates are at 4.73%. Down 17 basis points. Urban B-class cap rates are at 5.41%, down 20 bips. And suburban Class A cap rates are at 4.87%, down 21 bips. And suburban B-class cap rates are at 5.48%, down 20 bips. So that's interesting. So they're still saying that we've had some cap rate compression, at least in the urban class, in really kind of across the board. I think that is contra to kind of what we're seeing, at least on an anecdotal level, kind of across the board.
It is, in the same breath, they're talking about, and again, I said this before, about falling home prices affecting falling apartment prices. But then they're also talking about cap rate contraction. I will say, I liked this report because it was one of the few times where an apartment industry, where you get someone that's measuring the apartment market and they're willing to kind of tell it how it is, and to tell someone that falling home prices, just like rising home prices led to rising rents, everyone was hip to that.
Yeah.
Well, falling home prices could lead to falling rents.
Yeah.
And it's the same idea that this is housing prices in general that we're talking about.
Yeah.
And that kind of, not because it like bleeds over one to the other so fluidly, but the same forces that are acting on the apartment market
and I think the biggest point to what you were just saying is that it's household formation is really driving things more than anything. Mm-hmm. And that's what you have to really look at, even more than kind of external factors. And obviously price is probably the most important, but that household formation is that largest demand driver. Mm-hmm. And if it's positive or negative, I think it can have an outsized effect on pricing.
And it can move quickly. Sure. Like we've a couple weeks ago, we showed how quickly it can move.
Now, I would say that these cap rates that they are showing here probably aren't too far off, but I'd say they are elevated compared to what you're seeing in the markets. I mean, because we're seeing, in central region, 6 caps. We're not seeing any suburban B class 6 caps. Urban class B 6.17, even suburban class A 5.3, urban class A 5.25. I'm just not seeing that.
Yeah.
No, we're picking. It does exist, but we're still seeing a lot in kind of the upper to mid 4s, maybe at a 5.
Even if this was a lagging indicator, we haven't seen those numbers for a little while.
No, and just cap rate data is so bad.
Yeah.
But where are we in? Let's look at where we are in the
This is
cycle.
an interesting chart. It's an interesting measurement where they have where each market is in the multifamily market cycle, and I think maybe below they might define what these cycles are.
Yeah.
Expansion is decreasing vacancy rates, moderate high new construction. So these are growing markets, but not hyper supply, which are increasing vacancy rates where they're building too much with like negative absorption and moderate low unemployment growth. And then the other group is recession, which has increasing vacancy rates and then kind of lower construction. And then recovery is decreasing vacancy rates and low new construction. Kind of self-explanatory, but it's worth a little bit of a definition.
Oh, yeah. And so, like they said earlier, the majority of markets are in the expansion quartile. There's a lot of your Sunbelt markets. A lot of the kind of investor favorites, I would say, are in that kind of that early to mid expansion phase. Just some differentiators kind of in the earlier phase of expansion. You're getting markets like Denver, Indy, New Jersey, Phoenix, Portland, DC, markets that are kind of a little bit further along in the expansion, maybe a Columbus, Ohio, Fort Worth, Texas, Austin, Texas, Boston, Chicago, Jacksonville, Nashville, Pittsburgh, Orlando, OKC. And then out further into expansion phase, we got markets like Boise, Charlotte, Cincy, Dallas, Dayton, KC, Philly, St. Louis, Sarasota. But then hypersupply, that's something we got to have to watch out to, and kind of is already on the decline. We've got Minneapolis, Sacramento, Seattle, Birmingham, and then a little even further out is Charleston and Detroit. With only one market in recession territory, and that'd be San Francisco.
Now, this is interesting. Now, I kind of confused myself reading those descriptions.
Yeah.
Moving from recovery to expansion to hypersupply. So recovery is like you've got low supply coming, relatively low supply coming, but your demand is growing. And then as you move into expansion, the demand grows, but the supply keeps growing. And then at some point, you're going to tip into this point at which the supply is kind of eating up the demand, and then you move kind of into a recession where you've got too much supply, too little demand.
Yeah. And it's important to note that, again, this chart is not like a perfect scientific measurement.
Yeah.
There are probably some mathematical inputs, but it's not as though every market and you can have these charts for a variety of different asset classes, but it's not as though everything moves around at like the same speed, the same pace.
I like this chart though, and we've said this before. It's like you're getting the same information. This is probably moving with the same sets of whether it's from the Census Bureau or from their own data sets. But like we get the same info, but the way that they're classifying it really tells a story that you can see it as a group. There are groups of markets that maybe could be starting to tip over into we're building too much, but there are still a good chunk of apartments like Indianapolis or Denver or Portland that like we've got room to grow. And so I think it's really interesting to look at those. And I said earlier, if market supply is a problem, then it's a local problem first, and then you got to look. And so that's it's worth keeping in mind.
Absolutely, 100%, Matt. So this was a great report. Anything else I would like to highlight? We get into some other asset classes, or we'll save that for another time.
I'd like to say that if possible.
Let's save that. And by the way, you can find all these reports on the Gray Report every week sent to you. You can go to graycapitalllc.com/newsletter and be able to sign up. One more report for everyone. Fortune via Yahoo Finance. We're entering the next stages of the housing market. Matt, what the heck does that mean? Is it exactly what we've been talking about, or they have a different take on it?
So this
people
would be
need to stick around for the final segment.
Yeah, that's right. So
it's a new hot take. You have not.
You have heard everything before. No, this is the characterization, I think, of this month-over-month thing that I thought was persuasive here. You see, we saw in the Zillow, and if you go on to that specific report, we'll have the link in the show notes. But these steep falling home values. They pull out three things to expect, because Fortune says we're entering the next stage of the housing market, and it seems like that next stage is not as great as the stage that came before. Price correction is spreading, with prices falling through 2023. The housing downturn is probably going to spread beyond housing, and then sellers are calling timeout. Now back to the first one, the idea that the home price correction is spreading is pretty identifiable. I think that the voices are getting louder. I think that you're seeing more markets. Maybe it's at first is going to affect the Sun Belt markets, or at least maybe not even specifically the Sun, or in generally the Sun Belt, but more specifically those markets within the Sun Belt where they're building a lot. Mm-hmm. And it's also similar to the idea that things that affect the whole of the economy is going to affect housing and multifamily markets. I do think that Fortune overplays this just a little bit, as easy, and they kind of spin this out into it's a housing crisis all over again. So their idea that this housing downturn is spreading is I don't believe, and maybe it's a fundamentally different way of thinking on. Right now I'm thinking that the effects of the housing market are caused not by a self-sustaining process, and maybe it may get to that when it comes to housing sentiment creating a feedback loop. But right now it's settled by a defined cause, which is these higher mortgage rates. I think the demand, people still want to live somewhere, they still really want to buy houses, but they just can't because home prices are there. I don't think it's because of a fundamental structural problem. But I don't know that much.
Well, I just feel like it'd be hard for someone to be like, I need to sell my house now because it's going to be worth half. It's going to be worth much less. So I need to sell now. I don't know where I'm going to go, but it's just better to sell now. That takes a lot of conviction.
Yeah. That's a really good point.
I don't think people are there.
The fact that they're holding on is pessimism for the next couple months, but it's not pessimism. It's not a huge pessimism, a panic. So that's where I'm a little skeptical there, whether it's sentimentality or structural or other emotions, animal spirits, or this kind of structural system that may lead us to certain vulnerabilities. Mm-hmm. I don't think it's in the housing market. At least we were talking about what's the linchpin. I think it's not necessarily in the housing market. Although I'll read an article tomorrow that proves me wrong, I'm sure.
Well, we shall see. I mean, Jay Powell and Federal Reserve, they want the housing market to come back, values to come back. They don't care. They want to get inflation in check, and to do that, they have to destroy some value, destroy some growth.
Mm-hmm. So we've covered the first two were actually very similar, which is that the housing price correction is spreading and housing downturn is spreading beyond housing. Those are we've kind of covered those, and sellers calling timeout. We've kind of talked about that. What I do want to remind, and this redounds, I think, to the multifamily market. as much as housing prices are linked to multifamily prices, housing prices are so much higher right now than home prices. The average monthly mortgage payment is still at an elevated level compared to apartment rents. So it's not going to be an instantaneous effect. There is still a little bit of a cushion, but it may be coming. We may see some softening. We're especially seeing softening in home prices right now, but we're not yet at parity when it comes to rents and average mortgage prices.
Yeah. I just think it's smart for people to think in the long term, not necessarily the short term, and to do what you're convicted of and have confidence in, but you're never going to be 100% confident in anything. And it's going to be an interesting 6 months into a year.
And also, I don't want to do I don't want this to be my final comment because things could change, but I don't see rents, like I said before, I don't see the cool down of this rent growth anywhere as steep as the rise is going to be. I think we'll see things coming, and we know the inputs right now, and it's just a matter of, it's just kind of holding off, just like these sellers are holding off. It may be, I would hold the panic off, at least for now.
I agree. Matt, just while we have you here, do you have any comments on the fact that Adobe is buying Figma?
I've used Figma. I think Figma is really nice. It does some quick.
People are like, "What are we talking about right now?"
So Figma is this software that allows. It's really nice for collaboration. I would say
like graphic design and stuff.
Yeah. It's like a shared document for graphic design, and Adobe's bought it. Adobe already had a tool for collaborating, but it wasn't free. Figma's free. I don't know if they're going to make it not free. I talked to our web developer about that too. He's like, yeah, a lot of people don't like this. A lot of people think that Figma had this ethos of making something free, easy, not necessarily open source because there's a pro version, but it was an alternative, and now it's become part of Adobe. We have Adobe, and I like it for what it does, but I don't think it does things as snappy or as easy as Figma does. But if we could get Figma to convert things to a PDF more easily, then I will suspend all of my criticism.
Well, don't you think with Adobe they should be able to do that?
Exactly. So maybe it is
just a hot take, just sidebar on something that I know Matt would have some comments on. So if you ever whether we're making pitch decks, Matt's making graphics
behind the
scenes, but if somebody's watching this, who cares? Maybe. So if you enjoy this conversation, make sure you subscribe to the YouTube channel. And again, this is available wherever you get your podcast as well. Listen in the car while you work out. If you're a accredited investor and you're saying, look, I see what you guys are saying. There's headwinds across the board, but multifamily makes way more sense than anywhere else. I know you've got some awesome deals that you're coming out with. We just had a webinar that I can get the replay for. Hop on over to Gray Fund, learn more about the Gray Fund. Again, I can send you that webinar that we did yesterday. And I'd love to have a conversation with you about, making some investments into multifamily real estate alongside us. So see you next week on the Gray Report. Stay safe, make some good decisions, and see you next week.